They're not all created equal. You've got some that you really like. You've got some that you don't like so much, right? Who's positioned well?
So going into this quarter, our top pick Citi Group and Ally, in part because they're extremely cheap, I would argue. You know, the price to book for both of them is between 0.5 and 0.7. In addition, you know, their credit's they're largely reserved for their credit losses. And then the other one going into the quarter specifically is Goldman, because the capital markets are just extremely strong right now. You know, obviously you follow that every day, especially the IPOs and the M&A announcements, which are coming and will feed into earnings into next year as well.
You don't like PNC very much.
Well, that one's on our least preferred list, mainly because of the commercial and commercial real estate skew. Like, you know, lending to businesses and commercial real estate, that's going to take a little longer to get through loss content than consumer. And then the other piece is, look, this is a stock that's extremely, done actually really well, and the valuation is high relative to the group. So I'm a little bit more dumpster diving, you could say.
So you do not see necessarily a double dip in terms of just the economy. That would hit earnings, but you don't see it. Or the probability is low?
So, you know, we do as a firm, as Morgan Stanley firm, our economists do have a low probability on a double dip. That said, these banks are already reserving for a 9.5% unemployment rate. The unemployment rate right now, as you know, is 7.9. So we could have a small double dip here with unemployment moving back up, and the banks are already reserved for that worst scenario because, you know, a quarter ago the outlook was 9.5% unemployment at year end, and 7% was going to be the end of next year. So we can withstand a double dip, a small double dip in the bank group.
Shepard Smith here. Thanks for watching CNBC on YouTube.